Hello there. Okay, Dave Stanfield here, Evergreen Wealth Management, LLC. I just thought I'd take a few minutes to cover, I think, a topic that gets talked about a lot and certainly very much on the minds of people transitioning from being in the accumulation phase of their life to now in the distribution phase of their life. How in the world am I going to generate income from my portfolio once I retire? So you've done the great job, right, of saving all those years, accumulating money in various accounts, your brokerage account, your 401ks, IRAs, Roth IRAs. And now the time is, you want to retire. Let's say your expenses are $7,000 a month. You're going to get a couple $1,000s a month from Social Security. You may or may not do some consulting or have another source of income from a hobby or a small business. And now you have, say, $2,000 or $3,000 a month that you want to generate to meet that gap and meet your expenses in retirement. So a lot of different strategies and ways to go about that. I'll just outline three common ones. One strategy you may have heard of is sort of an interest-only approach. Or let's use $1 million as an example, and you're going to take that $1 million and you're going to invest it in things that pay either a variable rate or a fixed rate of interest. So let's use certificates of deposit as an example. Right now, your interest rates are low, but you're going to get in the neighborhood of 2.5% to 3.5%, maybe 4% on a longer term, but on CDs. So that $1 million, over a 12-month period, maybe they generate close to $30,000 a year or a 3% return on your money on average. So that's not really the most popular strategy right now, just because we're in such a low interest rate environment. Another sort of negative with that strategy is that it requires a very large amount of money to generate the amount of interest because the rates are kind of low, and there's also the matter of not having liquidity. You may have to tie up your money in a 1 year, 2 year, 3 year, either individual CD or individual bond investment, and if interest rates move suddenly, you have to wait out that time frame because the assets are locked up. So it may be a strategy that comes more into favor, or maybe you just appeal the simplicity of it and the conservative nature of it. But that's option one. Second option is what we call sort of a systematic withdrawal strategy. So let's say we take $1 million, we choose some typical basket of securities, say a portfolio of mutual funds or exchange traded funds, and then it could be really as simple as saying with whatever investment company you're with, I want you to liquidate, so let's say $3,500 a month from my $1 million portfolio, and so the portfolio is going to be going up and down with the market over time, but month after month, or you can set it up on a quarterly basis or even once a year. But a lot of people like the predictability and regularity, kind of like a paycheck of steady monthly paychecks, and just having that money automatically deposited to your bank account on a regular basis. So the benefit of something like that is that it's very easy to set up, very easy to implement. It's just a form in most cases, and then the checks start coming in, the deposits start coming in, and the market is going to swing up and down. One of the big pitfalls that I see is, let's say that you set up a strategy like that, and we go into a 2008 type of a scenario, and right off the bat, the market's down 20%. You had $1 million to start with. $800,000 due to market performance, and then you took $50,000 out, $50,000 out. So, the first 12 months of retirement, and you have a quarter of your assets are gone. So that is one pitfall that I see. And so some people elect to do a little bit more of a prudent strategy. The third option, where it's called more of a split strategy or a bucket strategy, a lot of people have heard of. So you take let's use that $1 million example again. Let's take a quarter of that, $250,000, put it into something, one bucket that's really designed for liquidity, meeting your expenses, and trying to get some interest where you can, maybe a CD ladder or a bond ladder. And the idea is that $250,000 is going to be there for income for say a 5 to 10 year period of time. Then you take the other $750,000, the remaining amount, and put that in diversified, longer term growth potential type of a bucket. And over that next 5 to 7 or 10 years, the idea is that you're going to try and grow and average a certain return on that portfolio. So the 250, you spend that down to zero over, let's say, 7 years, and then the 750, hopefully you grew that at a point where you could have either broken even or even stayed ahead of inflation, and then after 7 years, maybe you have $1,050,000 or 1.1 million. So that tends to get away or minimize the risk of the sequence of returns risk, where you're potentially forced to liquidate the portfolio when the market's going down. And I think that just a lot of people like that option. So anyway, a few different tips on how to generate income and some common terms for income planning for pre-retirees and retirees. Hope that helps. Thank you very much.